For most homeowners, selling a property is the largest financial transaction of their lives. When a home has appreciated over several years, the potential profit can be substantial. However, a significant portion of those proceeds can be lost to capital gains taxes. Without proper planning, the government may claim a large percentage of your home's equity. Specifically, you have to account for the Internal Revenue Service. Federal rules apply to every real estate sale in the country, and they typically require a cut of your net proceeds. But if you are selling in Florida, you have an immediate advantage. Florida is one of the few states with no state income tax, meaning you only have to focus on the federal side of the ledger. This environment allows many families to shield their real estate profits entirely. By following specific federal guidelines, you can keep your entire gain without paying a cent to the IRS. Understanding how these two layers of tax law interact is the difference between accurately projecting your profit and facing an unexpected bill after you leave the closing table. The first layer of this strategy is simply being a Florida resident. Because the state takes nothing from your income, your overall tax burden is lower than in most other parts of the country. With the state government out of the equation, the federal tax code becomes your primary concern. To avoid federal capital gains tax, you must satisfy a residency requirement, often referred to as the 2 out of 5 year rule. The parameters are straightforward. You must have owned and lived in the home as your primary residence for at least 2 of the 5 years leading up to the date of the sale. If you meet this residency test, the financial benefits are significant. Single taxpayers can exclude up to $250,000 of profit from their taxable income. For married couples filing a joint return, that exclusion increases to $500,000. There are also provisions for a partial exclusion. If you have to relocate unexpectedly for health reasons or a job change, the IRS may allow you to shield a portion of your gain even if you haven't stayed for the full 2 years. Meeting this 730-day residency requirement is the foundational step in ensuring the federal government stays away from your equity. But what if your profit is higher? In many Florida markets, home values have risen so much that your gain might threaten to exceed those $250,000 or $500,000 limits. In that case, you need to use your most effective defensive tool, the adjusted basis. Your basis is essentially what you have invested in the property. Permanent improvements like a new roof, a swimming pool, or a kitchen remodel count toward this total. Routine maintenance like painting or fixing a leak does not. Here is how the math works. If you bought a home for $300,000 and added $50,000 in permanent upgrades over the years, your adjusted basis is now $350,000. Now, imagine you sell that home for $600,000. After paying $40,000 in commissions and closing costs, you are left with your net proceeds. To find your taxable gain, you subtract the $350,000 adjusted basis from your net proceeds. In this scenario, your actual gain is $210,000. Because this gain is well below the $500,000 exclusion for a married couple, the federal tax on the sale is zero. By maintaining records of every major home improvement, you effectively transform receipts into tax-free dollars when it's time to close. Once the contracts are signed and the sale is final, you must determine what information needs to be shared with the IRS. If your total profit is fully covered by the exclusion limits, most homeowners are not required to report the sale on their tax returns at all. There are exceptions. If your gain exceeds the exclusion limit, or if you receive a Form 1099-S at the closing table, you must include that information on your next tax filing. It is also worth noting that the tax code is not symmetrical. If you happen to sell your primary residence at a loss, that loss cannot be deducted from your other income. The most effective strategy for a Florida seller is to verify that you meet the federal residency requirements and to document every major property improvement you've made. Calculating these numbers before you list your home is the only way to ensure you walk away from the closing table with your full profit and no surprises at tax time.